Good morning, everyone, and welcome to this year's EFG Financial Products Day. Glad you all made it, despite the snow, despite the weather. I'm very pleased to welcome you here this morning. In case it's your first year and you weren't here last year, my name is Ellen Frauenknecht. I work as a business journalist in Germany, but I'm very honored I may once again guide you through this exciting event. It's the 6th year that this event has been held, and while we're of course here to discuss the challenges that lie ahead in 2013 and in the years to come, I think it's worth recapping just for a minute where we started off, just to put it all a little bit into perspective. In 2008, in year one, the EFG FP Day focused on modeling, the modeling aspects of credit markets and the valuation crisis that occurred at the time. A year later, in 2009, the buzzword was transparency. In 2010, everyone thought now it was really time to discuss the year after the crisis. Of course, by 2011, everyone realized that A, the crisis was far from over, and B, financial markets were increasingly influenced by forces other than demand and supply. Now, last year, in 2012, our keynote speakers and our panelists discussed the Eurozone primarily, if the Euro and the Eurozone will survive the significant stress test, if the Eurozone will make it or break up. This year, the Euro and the Eurozone still are around, but they're certainly not out of the woods just as yet. I think it's fair to say that if we have learned one thing over the past few years, it would have to be that we do not know an awful lot of things with regards to the Euro crisis, with regards to the dynamics of financial markets, and possibly in general with regards to human behavior. Economists are running up against the limitations of their science more than ever before. There is a great deal of uncertainty, but fortunately uncertainty can also lead to undiscovered opportunities, and that is our aim today. We want to find some of those opportunities. We want to hear how we are supposed to live in a world we do not understand, how we're supposed to make decisions under opacity. The latest in the Euro crisis, the health of Switzerland, frontier and emerging markets, all those are topics that we are going to touch today, during the day, and they'll all be addressed by our speakers. A number of distinguished experts, both from the investment world as well as from academia, will be here today, talk to you, offer solutions to make predictions. But of course, having said that, bear in mind that experts can be wrong too at times. We've heard that many times, or witnesses over the past years, so do think critically for yourself today. Do challenge what they are telling you. It's a terrific opportunity for you to grill them face to face here today. We all know it's very difficult to free up some time in one's busy work schedule. You managed to do so, so now make best use of it. They're all very critical thinkers, so I'm sure they can take it if you ask them a few tough questions during the day and challenge what they tell you. Finally, just one more important note or one wish. We will have 3 breaks today, so there will be plenty of time to check your emails and to make important calls. So if you haven't done so already, please switch off or mute your cell phones now. And once you've done so, please raise your hands for your host today, for Jan Schoch, the CEO of EFG Financial Products. Welcome.
Good morning, ladies and gentlemen. Good morning, dear investors, dear clients, board members, and speakers. This is the 6th EFG Financial Products Day, as mentioned by Ms. Frauenknecht. And I'm pleased and proud to kick off this event, and thank you for joining this day. I'm not sure if all of you have already arrived. There are certainly some people which have been stuck in the snow. Took me 2.5 hours to get here from Appenzell, but I have gotten in time anyway. This is the 6th year which we are in this EFG Financial Products Day, and also as a company in this market. And it has been an eventful number of years when we look back. And last year, one can say, was certainly not an exception to that process which we have seen. We have gone in the last 6 years from more laissez-faire, initially, economy and environment, in a more regulated and risk-averse environment in which we are today. And it was certainly an interesting idea to come up with a platform to exchange between the business and science and have a platform where we find orientation ourselves in uncertain times and can look a bit forward. It is a very transparent and neutral platform. We invite therefore a number of professors today. We have, including Peter Forsmoser, 4 professors with us. We have seen in the short history of the last 6 years, certainly a lot happening in this world. We went from a robust bull market initially into certainly a big crisis triggered by the US real estate bubble. We went into a financial crisis, which ultimately triggered a debt crisis, led into a political crisis, and in some countries, even a social crisis. Now, the question certainly is how that's going to go forward. Last year has kept us busy with the European debt crisis developing. We have seen some stabilization by the ECB happening in the mid of the year. The question is, what is going to happen this year? Emerging markets and developed markets have helped to support the world growth, and that's also why we have emerging market as a topic today to talk about. Is that actually supporting 2013? One of the questions. We are clearly still in a debt crisis. Nobody can kind of avoid that fact. The question is, what is next to come? Is there a resolution? I don't see any specific point in 2013 which would resolve the current situation. Is there another financial crisis being triggered by the debt crisis, i.e. we are going backwards again from a financial into a debt and back into a financial crisis? And what is the impact on the economy and the growth in this world by this debt load which we are pushing ahead of us? And are we just going to push that further in 13? And what does that mean to us? We had a good equity year and a good bond year, although last year, given higher volatility. Is that the same again this year, or is it going to run out of steam? EFG Financial Products, not only the market, but also the company, we had an eventful year. We had an IPO, thanks to the help of many of you who are here today in autumn, and that has helped us to trigger actually additional growth and follow up on our new strategy of focusing on our platform and not only on the products in themselves. And we are very motivated to drive this forward. We believe that there are opportunities also in difficult times. I think we are a good example of that. We believe in actually exploring these opportunities. There are clearly opportunities in frontier markets and emerging markets. Again, we're going to hear about the topic. Is that the way forward? What about the developed markets? How are they going to change? Are we going to restructure? Are we going to find a way to reinvent ourselves? I think it's down to all of us to actually find a new sustainable market model which actually works, and then there will be opportunities for the developed markets as well. And I think this is one of the events where we can exchange ideas and find new guidance for 2013 and going forward. This is also the reason why we called it Uncertainties Lead to Undiscovered Opportunities. So let's focus not only on the past, but let's focus on the future, and let's actually see where the opportunities are. I'm proud to actually introduce to you the respective speakers today. We have Professor Dr. Hans-Werner Sinn with us. He is Professor of Economics and Public Finance at the University of Munich and President of the IFO Institute, and he's going to kick off today. We have Remy Bryant here. He's Head of Index Research at MSCI. Professor Urs Pichler, he's Professor at the Banking Institute, at the Swiss Banking Industry at the University of Zurich. And we have Nassim Taleb with us in the afternoon, Professor of Risk Engineering at New York University Polytechnic Institute. So we're looking forward to these presentations. Also welcome to Peter Forstmoser, our chairman of EFG Financial Products. Special thanks to Ms. Frauenknecht for actually leading you through this day and hosting also the panel, which is going to be an interesting point in this day, I believe. I'm not going to stretch it further. I wish you an enlightful and actually hopefully guiding with new ideas into this day and into the year. Thanks to this opportunity for being here. Thank you for your trust. Thank you for your support in uncertain times. And thank you for joining the EFGFP Day. Enjoy.
Now, our first speaker today is someone most, if not all of you, will know, not only because he's a president of one of Germany's most influential think tanks, but also because, like no other professor, he has shaped the economic debate in Germany for a very long time, very often with bold theories or provocative pronouncements. Around the turn of the millennium, when the German economy was in the doldrums and Germany was considered to be the sick man of Europe, he suggested that labor market reforms would have to be much more severe to bring the country's job slump to an end. A few years later, he warned that Germany, the world's top exporting economy at the time, had deteriorated into a bazaar economy because it had too many foreign suppliers. And now he promotes a theory that the rescue policies coming from Brussels and many of the things that the European Central Bank has been doing are not solving problems, but are in fact making them worse. It was also very interesting to see last year, after Chancellor Angela Merkel had agreed to a European banking union at a EU summit, he, in a joint letter signed by more than 200 economists, cautioned against the incalculable risks of such a move. It dominated the headlines in Germany for quite some time. And I think it also gives you an idea why so many people admire him and probably just as many people also fear him. It'll be very exciting to hear his assessment of the current situation in Europe. So, ladies and gentlemen, please welcome Hans-Werner Sinn, Professor of Economics and Public Finance at the University of Munich, as we heard, and of course, the President of the IFO Institute. Welcome.
Ja, liebe Frau Frauenknecht, Herr Schoch, ladies and gentlemen, the crisis has calmed down, but has it disappeared? I don't believe it either. Mr. Schoch, I think you're right. And I'm grateful for having the opportunity to talk to you about the general picture and an assessment of where we are. Thank you for the kind words about the past. Economists always want more than has been done by the Schröder government, for example, but I'm not a critic of him. He was great. I think the reforms he did were just right 10 years ago, and exactly these reforms have to be done now in a couple of other European countries. The European Balance of Payment Crisis, this is my title. It's an ordinary balance of payment crisis of the sort which we have in fixed exchange rate systems, but it's not perfectly the same, as you will see. I will try to understand this by looking to the bubble in Southern Europe, the loss of competitiveness resulting there, then the role of the ECB. I will add a country analysis, give a policy evaluation, talk about the US example, and speak about necessary reforms. So the whole thing started with the euro. The euro brought an interest conversion, as you see here. One country was missing, Greece. And you see this interest conversion came after the Madrid summit in 1995, when it was announced that the euro was really coming, when it would be coming, which countries would be participating, and it was clear that by May 1998, the exchange rates would be irrevocably fixed. So within 2 years' time, the interest spreads disappeared. There was no exchange risk anymore. And then came the good period of the euro, but it was a limited period, as we see. And then the crisis swept over from America in 2007, and the spreads went up now because of bankruptcy fears. Basically, it's the same problem. At the time before the euro, one was expecting that the countries were not able to repay and would try to avoid that by inflating their currencies and devaluating them externally. And now the fear is that the countries still cannot repay, but given that they are in the euro, they just default. However, as you also see at the right-hand side of the picture, things are calming down. The spreads since last summer have declined enormously, and we have an intermediate phase where the announcement of Mario Draghi to use taxpayer money to repay the government bonds of southern European countries, if necessary, worked and calmed the market. Now, this period here, where the interest rates converged, was a period of loose budget constraints for Southern Europe. All of a sudden, one saved a lot of money. Italy saved more money through the interest reduction on government bonds than its whole value-added tax revenue. Had they used that money to redeem their debt GDP ratio today would be 18%. 18% rather than 130 nearly. Also, the low interest rates were an incentive to borrow abroad. Greece and Portugal borrowed in order to increase the wages in the government sector and employ more people in the government sector. In Spain and Ireland, we had a real estate bubble, so credit was flowing into the country, nourishing huge construction investment. Which meant that there were lots of jobs in the construction industry. In the end, it didn't matter where the credit entered the countries. In Greece, the government employees were building homes, and in Spain, the construction workers were paying taxes. So the respective other sector was automatically participating in the boom. It was an inflationary boom. There was some real growth, but nominal growth was driven by inflation, and that deprived these countries of their competitiveness, as we will see. And now we have the current crisis, which temporarily seems to be fading out. Here you see what happened in this period of credit flow to Southern Europe. The current account deficits grew of the crisis countries. GIPS-6 stands for Greece, Ireland, Portugal, Spain, Italy, and Cyprus. And this, by comparison, is the German current account surplus. Ms. Lagarde called this the Euro tango, which I find very appropriate. I would actually like to have a dance with her. She's a very attractive lady. As you see here, the current account deficits of the GIPS-6 countries are improving. Unfortunately, this is not a substitution effect due to an improved competitiveness. It's nearly exclusively a reduction of imports due to the contraction of these economies. That's unfortunately not what we want. We want, given the employment, a substitution away from foreign towards domestic products. So both foreigners should buy these domestic products, and the domestic population should buy their own products. That kind of substitution effect. Unfortunately, that is not yet what we are seeing. And the reason why we are not seeing that is that these countries have become too expensive. Here you see the price increase, the GDP deflator, from 1995 to 2008 of the now Euro countries. And here the red bars show most of the crisis countries. Germany, by comparison, increased its prices only by 9% over these 13 years. So the other countries revalued in real terms, and Germany devalued. In trade-weighted terms, the GIPS countries, now without Cyprus, we don't have the data, appreciated by 30% against the rest of the Eurozone, and Germany depreciated or devalued by 22% relative to the rest of the Eurozone. And this is the major theme underlying the crisis. The price vector is wrong now. We are stuck with this wrong price vector, and all the distortions result out of that and won't disappear unless we correct for that. Greece, to have a comparison, is 64% more expensive than Turkey. This is simply not possible. The same water, the same temples, the same food, you can't be 64% more expensive. And by the same comparison, Portugal is 47% more expensive, meaning that in order to become competitive, Greece will have to devalue by 39% and Portugal by 32%. These are huge numbers. Never in history have we seen real devaluations of that order of magnitude somewhere in the world. There's another calculation a model-based calculation by Goldman Sachs. Last spring it was published, a very good study. They said that Portugal will have to cut its prices by 35%, Greece by 30%, Spain by 20%, France by 20%, Italy 10 to 15%, Ireland not. Ireland has done it, as we will see. Cutting the prices is always relative, not in absolute terms. Either Germany inflates by 64% and Greece becomes competitive that way, or Greece devalues by 39%, or Goldman Sachs number 30%. These are huge numbers. A real devaluation through price cuts is hardly possible, as Keynes has emphasized, as Friedman has emphasized. They had different opinions in many fields, but here they fully agreed. And Friedman actually, for that reason, said 20 years ago that the euro will just have 10 years before the crisis breaks out, and he was perfectly right. Perfectly right. Germany in the Weimar Republic was unable to change its exchange rate to the gold, while other countries were devaluating their currencies relative to the gold. So Germany lost its competitiveness and had to cut its prices internally in exchange. And from 29 to 33, German product prices declined by 23%. But that was a period when there was shooting in German streets, and when the country was driven to the brink of a civil war, and what came in 33, as you know, was worse than a civil war. So my assessment is that Portugal and Greece have no chance whatsoever to make it in the Eurozone, because these numbers are simply too big, and because they are cut off from the capital market, while Spain and France, if they are willing to go through a 10-year stagnation or so, staying behind with their inflation rate 2% behind the rest, they can make it. That's the difference. Germany has shown in its own euro crisis, from the announcement of the euro until Lehman, that 22% real devaluation was possible. So that same sort of slump as Germany experienced with mass unemployment is something which would bring Spain and France on track. Of course, not a growth program as Hollande thinks. That's the opposite of what you need. Here you see what has been achieved. Sorry. This is the GDP deflator relative to the rest of the Eurozone. This is the target level, according to Goldman Sachs, where they would have to come. And you see Greece From the beginning of the crisis, autumn 2007, when the interbank market had broken down the first time, until now has revalued rather than devalued relative to the rest of the Eurozone. There's a very long way from there to the level which implies 30% devaluation. Very long way. A little bit we see last year. Now there is some movement, wages are coming down, prices are coming down, but how long is that way? This is Italy. This is the target level, and that's where they are. Italy is still inflating. Even the forecast for this year, which the IFO has made, shows it's inflating faster than the rest of the Eurozone, and Germany less than the rest of the Eurozone. So we are not moving in any way in the right direction. We are moving further apart. This is France. Not the slightest sign. The French crisis is yet to come. I mean, it's on the way. It's on the way. It's clearly a competitiveness crisis. Renault has cut lots of jobs, as you know. The manufacturing industry has shrunk to 9% of GDP in value-added terms. This is even less than the British number. So what will France do? I don't know what that implies for the Eurozone. Because wishful thinking and proclamations of politicians won't make it. You know, whatever they think about Europe and dream is the laws of economics don't care. Here we have Portugal. There we have the largest gap between what is necessary and what they have done. And here we have Spain. And here we have Ireland. There you see the difference. Ireland devalued by 15%, starting already in 2006. Why Ireland and why not the others? Well, very easy. Ireland's crisis began 2 years earlier than the crisis of the others. They came after Lehman. Ireland stood alone. There was no special program of the ECB, let alone an intergovernmental rescue program. So they had to help themselves and were cutting their wages and prices in a two-digit manner. And that has improved their competitiveness. They are out of the doldrums. The current account deficit has turned positive. Ireland is fine. And this is why Goldman Sachs says they don't have to devalue. They have done it. But the other countries did not follow the Irish example because they were so many. When you have a problem and you're standing alone, you have to solve it alone. When everyone has the same problem, you have different possibilities. And you use your majority in the ECB Council and in the EU in order to organize different solutions. And these different solutions were public credit through various channels, about which I will speak. So that made it unnecessary for the countries to go the Irish way and become more competitive. Here you see another statistic showing some light, shedding some light on what's going on. This is public and private consumption relative to net national income. Germany is here standing at 90%. Ireland is standing at 95%. Italy is already consuming all its national income. But here are our two problem countries, Portugal and Greece. Greece is a disaster, you know. They are moving towards 120% and beyond. We will see it in the next 2 years where that goes. This is simply not possible. It's not a sustainable situation. Now the crisis swept over from America to Europe. Banks had lost lots of equity capital, became nervous, risk-averse. They became more risk-averse also, and looked more carefully into the investment opportunities. They were withdrawing their funds from the southern countries because they thought they won't get their money back. And that led to the crisis we are still in, the European balance of payment crisis. Now, the current accounts you cannot change. They result from the wrong price vector, and prices change only gradually, slowly. So the current accounts have to be financed. If they are not financed, the economies collapse. They are partly collapsing now, but they are also financed to some extent. Who financed the current account deficits? The answer is the ECB. The ECB has done two things. It has bought government bonds and it has provided refinancing credit. Most people talk about government bond purchases, and here you know we have this big dispute in the ECB Council between the Bundesbank and the rest of the Eurozone. Bundesbank President Weber resigned under open protest against this policy of repurchasing government bonds in the secondary market, arguing that this is a circumvention of the Maastricht Treaty, which forbids government finance with the printing press. And Chief Economist Stark also resigned half a year later after Weber for the same reason. They publicly announced the reason. And then came Weidmann, and one thought he would be more flexible, but he isn't, and he expresses his protest against the ECB policy in the open. There is war in the ECB, as you know. Whether this war, where this war will lead, whether it's compatible with the sustainable development of the Eurozone, I doubt that. What eruption is yet to come because of this war is unclear. Now, the Bundesbank is in opposition. The federal government in Germany is in favor of Draghi's course or decisions. So, for the time being, the problem is kept under the carpet. But the main thing which the ECB did was not buying government bonds. This is of minor importance relative to the provision of target credit. What is target credit? It is an extra refinancing credit leading to net transfers of money across the borders of Europe, net payment orders. And this has built up claims and liabilities in the euro system, which has made Moody's nervous. Moody's announced that it considers downgrading the Netherlands and Germany, also because of their target problem. That's what they explicitly said. Here are the numbers. This is the target debt of the GIPSIC countries, increasing up to 1,000 billion euros. From the time of the beginning of the crisis, the autumn 2007, that's when the thing began. And at the margin here on the right-hand side, things are improving and calming down since the summer last year due to Mario Draghi's announcements, whatever it will take. And here is the respective figure for Finland, Germany, Luxembourg, and Netherlands. This is a claim. This is a claim a target claim which you find in the balance sheets of the central banks of these countries, which fits exactly, nearly exactly, the liabilities that you find in the balance sheets of the GIPSIC countries. If you break it down by country, these are the most up-to-date numbers. They are not all from December. Some are earlier because the countries publish at different points in time, and the ECB up to this date has not yet come up with a statistic about it. They just don't want to hear about it. You see that Germany, the Netherlands, Luxembourg, and Finland are having big target claims, and the GIPSIC countries together have a target liability of nearly 900 billion euros. What is it? This crisscross movement of money characterizes a balance of payment equilibrium. There are payment orders across the borders because of goods transactions, because of financial transactions. You give a credit, you give a payment order to some country, or a credit is being redeemed, the payment order goes the other way, you buy an asset, all these payments make the balance of payments statistics. And usually they balance out. Green is here a credit and credit flow, and yellow let be the goods flow. So that was the situation until 2007. But then when the markets became nervous, two things happened. First of all, the credit flow stopped. The banks of Northern Europe, of the core countries, the Netherlands, Germany, were not willing to provide credit any longer. And the southern countries still, however, wanted to buy their goods. So wanted to finance the current account deficits. That meant there was a net outflow of money, net payment orders from these countries to the north, implying that the central banks of the north had to carry out these payments on behalf of their company in the southern countries. In addition, the banks of the core countries also wanted to return the existing credit that they had provided earlier. At maturity, they asked for repayment. So there was, in addition, an outright capital flight. It was a reversal of the capital flow. The current accounts were no longer financed. And in addition, the existing stocks, which had been built up previously from earlier current account deficit financing, were being withdrawn and recalled. So even more net payments from the southern countries to the core countries. So this is what target balances are. They measure the accumulated net payment orders. It's not the flows, it's the stocks. They are carried on from one year to the next with interest in the balance sheets of the respective countries. And in addition, these net payment orders mean, of course, credit, because if a Greek central bank asked the Bundesbank to carry out a payment on its behalf because they want to buy a Volkswagen or because they want to redeem the debt with the Deutsche Bank, then the Bundesbank does the Greek bank a favor. It gives them a credit because it pays out the money on its behalf. This process of carrying out net payment orders means automatically giving a credit to the respective other central bank. But what happens in this process is that in those countries where the net payment orders are being made, the stock of money balances shrinks. And there is not very much money in the economy. It's only 10 to maximum 20% of GDP, which you need for liquidity purposes and transactions. So if you have net payment orders going to other countries, then very quickly the stock of money has evaporated. And so it's not possible. These net payment orders automatically require the reprinting of money. You reprint money and give new refinancing credit. That goes hand in hand. Therefore, the target balances indirectly, but quite accurately, measure also the extra refinancing credit provided in the southern countries beyond the local liquidity needs for the purpose of buying goods and assets elsewhere in the Eurozone, and in particular for redeeming the debt. The debt redemption is the capital flight. The interbank market broke down. The countries of the core, the banks of the core, were withdrawing their funds from the south. Actually, what happened was that it was basically the French banks that were withdrawing their funds from southern Europe, and so they needed less credit from Germany and the Netherlands. There is this triangular relationship in the capital market of Europe, which is very crucial. So Germany has always been the country, the biggest capital exporter after China. Actually, last year it was the world's largest capital exporter before China. And so the German money went to France, to the French banks. The French banks were distributing the money in Southern Europe due to their special relationships. And then the money returned to Germany for buying the goods. This triangular relationship is what happened. And in the crisis, the French banks were retreating back from Southern Europe. And also, they were repaying their credit to the German banks because they didn't need that anymore. So France didn't have target balances, but Germany and the southern European countries developed huge target balances. Okay, so where the net payment orders are made, you automatically reprint the money and give new refinancing credit. And what happened in the core? There was this net money flow coming in, money creation without credit provision, as is usual. So there, this extra money was used to repay the refinancing credit, which the banks had taken from the respective central banks. In the core, the net refinancing credit actually became zero already in the summer 2011, and since then it has become negative. So the Bundesbank and the Dutch central bank have become debtors of their respective commercial banking sector since the summer of 2011. And all the refinancing credit that exists in the Eurozone has been issued exclusively in the 6 crisis countries. All the money comes from credit operations in the 6 crisis countries. No money in the Eurozone has its origin anymore outside these 6 crisis countries in terms of credit operations. Which is the basic difference between Europe and the Fed. The Fed would, when it does its open market operations, never have a biased purchase of these portfolios. They always have a balanced portfolio. They would never issue money in particular in favor of countries that have difficulties. California has no chance whatsoever to get directly or indirectly the money the government needs from the printing press. To the contrary, they retreat from there and they don't buy the government bonds of problematic states. This asymmetry in the money creation is the speciality of the European system. The money being created in Southern Europe has increased by a factor of 10. But the money didn't stay there. It went to the north, and in the north it was shredded. You print in the south, buy whatever you like in the north, and the north destroys the money. So banks place the interbank credit no longer in Southern Europe. They put it directly to their central bank and have a claim against the central bank, meaning that the money comes out of circulation. That's what I mean with shredding. It's not a physical process, please. It's all electronic. Why was it so easy to use the printing press in the South? You would think we have a Eurozone, everyone can print a little bit of money, everyone has its national central bank, small country like Greece, small printing press, big country like France, big printing press, somehow it should go in proportion. Not the case. Everyone can print as much money as he wishes, according to the rules of the ECB, of course. Cyprus now solves its problems with a printing press, because it's easily accessible. In principle, there could be a limitation by country size insofar as for refinancing credit, commercial banks need good collateral. Small country has little collateral, big country has much collateral. So a big country can draw more refinancing credit. But this kind of relationship has been weakened enormously during the crisis. The collateral requirements were an A- grading until Lehman, but thereafter it was put to BBB-, which is one step before the trash level, no investment grade level. Twice the ECB announced that it would return to normal. They didn't. Up to this day, this is the requirement. Okay, that lasted for a while. There was enough bad collateral of that sort for a while to finance the respective countries, but then the countries went out of even this type of collateral. The next step was that the ECB Council then announced that it would accept the government bonds of Greece, Ireland, and Portugal, regardless of what the rating agencies said. So that helped again for a while. You had, again, good collateral for a while. But when the capital flight in Ireland occurred, this simply wasn't enough. So the ECB was allowing Ireland to provide ELA credit. This is extra refinancing credit without the other European countries to participate in the risk. It's on the risk of the Irish state. In the end, it makes no difference whether the Irish state directly guarantees this credit or whether the collateral is an Irish government bond. It's also the Irish state. But technically, it's a little difference. That lasted for a while, but wasn't enough. Then the ECB decided to allow ABS paper, which the banks could artificially create, non-traded ABS papers. These sausages, which were in the center of the American crisis, structured securities with lots of claims bundled. And as with real sausages, one would not really like to know the ingredients. But some people have looked into it. They found, for example, in Portugal, an asset with a maturity lasting to the 31st of December of the year 9,999, endowed with a rate of interest of 0. And also, the steps market, as we have recently heard, which is organized by the Banque de France, seems to be full of very problematic assets, which are used as collateral. And moreover, the ECB has now begun to allow direct titles from company credit to be used as collateral. They claim, of course, because they make risk deductions, that this is all safe. One can doubt that. Spring last year, it was clear that the government bonds of Greece clearly were no longer suitable, so they were not accepted by the ECB, and Greece had to go to ELA credit because the safety margins, the deductions which the ECB had taken were not sufficient. This is the problem. This is the reason why Jens Weidmann, a year ago, February last year, wrote this nasty letter to Mario Draghi complaining about the lack of collateral, good collateral underlying these target credits. This letter was not supposed to be known by the public, but the Frankfurter Allgemeine published its content, as you know. So what happened here was that the printing press was underbidding the capital market. Whatever you think about what the ECB does, whether right or wrong, I don't say it's entirely wrong, as you will see, it was underbidding the capital market. If you don't underbid the capital market, then no target balances can arise. Banks in the southern countries found it more attractive to draw the credit from the printing press than going to the banks of northern Europe to ask for credit there, because the conditions would be very bad for them. The combination of maturity up to 3 years interest rate, now 0.75%, and bad collateral with which Mario Draghi satisfies himself is not sufficient for any normal commercial bank in Holland or Germany or Luxembourg. So these sorts of credits from the printing press result from the fact that the printing press underbids the market. And while the ECB argues there is an exogenous capital flight, they have to compensate. You could also argue they created the capital flight by underbidding the market. If the printing press is cheap enough, then of course the interbank credit is being withdrawn and you have your target credit. Let's look to the separate countries, what happened here. This is the development of the Greek target debt. Over time, you see it began in early 2008. And here we have the intergovernmental aid, which is given to Greece through the various rescue programs, including the IMF money. And by comparison, here I have the accumulated current account, where the 1st of January 2008 is set equal to 0, and the yellow curve gives the foreign debt built up by Greece because of its net imports of goods from other countries. And interestingly enough, what you see here, the total current account deficit has been financed with the printing press over the period. So that is the answer. The White Knight who rescued Greece was the ECB. It financed them, has financed them throughout the whole period, right from the beginning, when they were cut off from the capital market. And ironically, the extra money which came from the community of states through the EFSF and so on was all money that went back, so was in addition to financing the current account. So that money must have nourished a capital flight out of this country. It happens to be, I mean, it's not a causal relationship here, but it happens to be equal to the capital flight out of Greece. It didn't stick. It all came back. Maybe to Switzerland. One says 120 billion euros have been parked by Greek people in Switzerland. I don't know whether that is right. This is the number for Portugal, the target debt, the intergovernmental aid, and the accumulated current account deficit. And also you see that over the years accumulated from the beginning of the crisis, all the current account deficit has been financed with a printing press. I mean, again, it's not a causal relationship. I could draw the picture the other way around, begin with the green below, then you would see that the printing press financed some capital flight in addition to the current account deficit. But it's useful to compare these numbers. Ireland, huge target debt, but and plus intergovernmental aid, but very little current account deficit. So here in the case of Ireland, this has very little to do with one another. Obviously, the money printing press was used to finance the capital flight from Ireland. Again, it's not a capital flight of Irish people to some other countries, but a capital flight of investors from the core back home. It's a retreat back home. Actually, in the crisis, everyone was going back home. Spain. In Spain, there was not a target problem in the first years of the crisis. Only about a quarter of the current account deficit had been financed with target debt. Oh, I'm sorry about these numbers. Something is wrong here. But until the summer of 2011, 11, but then, as you see, the target debt surged, and that was the capital flight from Spain. There was a capital flight beginning in the summer 2011 from Spain and Italy, which had to be replaced with a printing press. Here you see the Italian capital flight and the Italian current account, accumulated current account deficit. In both countries, the printing press was activated so much that still accumulated over the whole period, the whole current account deficit was financed with the printing press plus a little bit of net capital flight. All the capital import, that's another way of expressing it, that had occurred to Italy until the summer of 2011 turned into a capital export, a capital flight, and even more than that was leaving the country. And from a German perspective, here the target claims compare well with the accumulated current account surplus of Germany, telling us that practically all the current account surplus Germany earned with the rest of the world was target claims of the Bundesbank. Normally, if you have an export surplus, you have the money to buy assets in other countries, marketable assets, real estate, whatever. That's normally connected with it. But this time not. The only thing that happened is that the Bundesbank received according claims against the ECB system, because the other countries were just ordering the goods, and rather than paying, they allowed the Bundesbank to write it on to its balance sheet. These are just book claims, and the private banking sector has brought the money to the Bundesbank. So private individuals have the feeling that they have some real wealth, but it's wealth in terms of claims against the Bundesbank, and the Bundesbank has a claim against the ECB system. A claim, by the way, which vaporizes should the euro disappear, because if there is no euro, then you have a claim against a system that no longer exists. Here, interestingly enough, the current account surplus of Germany with the rest of the Eurozone is much smaller than the total current account surplus. So what it tells us, not even the net exports of Germany to Southern Europe and so on have been financed with target. Even the net export of Germany to China has been financed that way. Why? Because if a Greek person wants to buy a Chinese product, he goes to his bank, takes a credit, the bank goes to the Greek central bank. The Greek central bank makes a payment order to a Chinese agent somewhere else in Europe, and the target balances arises. Or the Greek buy dollars from the ECB, and also a target balance builds up. And when then the German exporter gets the dollar, he gets a target. Germany gets a target claim against the ECB system. So even Germany's export with China is financed with extra money printing in Southern Europe. The policy evaluation. Let's look to the total numbers paid out to this day. These are all the rescue monies. This is target credit, nearly 900 billion. This is 200 billion ECB purchases of government bonds. This is the intergovernmental rescue programs for Greece, for Ireland, for Portugal, and now for Spain, making a total of 1,400 billion euros public rescue credit to the crisis countries, of which 337 or 24% were controlled by the parliaments of Europe, and 1,065 billion euros, or 76%, were tolerated and actively given by the ECB. Mostly it was tolerated. These things happened. One didn't say no. One set the rules with reducing the collateral requirements such that the southern central banks could draw the money out of the printing press. But to some extent it was active policy when it comes to government bond purchases. This is a major legal problem, I would say. Does the ECB have the right to provide so much credit relative to what the open rescue operations controlled by parliaments do? The ECB says, yes, this is our mandate. This is all monetary policy, but there can be different opinions. Ottmar Issing, the former chief economist of the ECB, recently said at a conference when he was asked to comment on the monetary policy of his former institution, I swore myself not to comment on the monetary policy of my former institution, but given that this is not monetary policy, I may well criticize it. And then he began. It's not monetary policy. The allocation of money across the European countries is not changing, neither is the stock of money in the aggregate changing. It's pure credit operations. What happens is exactly the same as if the ESM borrows funds in Frankfurt and transports them to Greece so that the Greek can buy the German cars. It's exactly the same thing. Or redeem the debt with the Deutsche Bundesbank, for example, because the terms of the printing press are better than those of the Deutsche Bank. And now the ESM has been agreed, and that money is yet to come. If they leverage it by a factor of 4, as is intended, it will be another 2 trillion, making a total of 3.4 trillion, which happens to be exactly equal to the government debt of the 6 crisis countries. I see a particular path dependency here in the European development, which has given the name to my book, Die Targetfalle, the target trap. What I mean here is that we have various steps in a sort of Ponzi game, which is taking place, where at each step of the Ponzi game, there's no alternative but finding the next group of participants in the game, because otherwise there would be a collapse. So you can't blame politicians, you can't blame Mario Draghi, you cannot blame anyone. It's built into the system. Once you've started that, you have to continue. The first step in this Ponzi game was the creation of the euro as such, providing cheap credit without appropriate risk premia to Southern Europe, creating this incredible credit bubble, real estate bubble, with exploding price levels, depriving the southern countries of their competitiveness. Then, as the market is no longer willing to finance that, there would have been a collapse, 2008, had the ECB not stepped in with the printing press. So there was no alternative for the ECB. It was perfectly right what it did, to step in and finance these countries, finance the capital flight and the current account deficits. What can you say? It would be wrong to blame Mr. Trichet. He had no choice. But then it went on. Then Trichet saw that all the money was being printed in Southern Europe, and the money in the North, through credit operations, was shrinking, and he wanted to keep the balance sheets in order, and he thought, what can we do in order to have a more symmetrical money creation? And then he thought it would be best to ask the central banks of the North to buy the government bonds of the South. So these are the secondary market government bond purchase programs. That's what he began in May 2010. It's very rational to add that to keep the target balances low. And it continued, as you know, with Mario Draghi's announcement of September, whatever it takes, we will provide it. unlimited purchases of government bonds. That brings down the target because the Bundesbank, for example, is forced to buy Greek government bonds. So the bonds flow from Greece to Germany, and the money flows from Germany to Greece, reducing the target balances. It's a repackaging of the type of credit. The target credit becomes another type of credit in forms of government bond purchases by the northern central banks. But the politicians did not like that. They thought the ECB is perhaps overstepping its mandate. It should not do that. The ECB Council, where every country has one vote, Malta has one vote, Germany has one vote, is not the right body to make such fiscal decisions. So let's set up a fund in Luxembourg, the EFSF, and now the ESM, to do the same. That was the argument with which the majority leader Kauder convinced the CDU in the last winter, a year ago, that they had to accept the ESM as a permanent rescue operation. He said, then the ECB can move back and we have full control, we have voting rights according to the size of the country, we have qualified minority rights and so on. So the ESM logically also follows from the existence of the prior rescue operations of the ECB. And you see what I want to say, Every step follows logically from the previous one without hardly any alternative. It's a path dependency in the European development. But it goes on. Now we have a banking union, not only a common supervision, this we urgently need, but we will also recapitalize the banks of Southern Europe with the ESM money. Why that? Because the ECB is now in trouble. As I said, the target credit means 900 billion extra refinancing credit to the 6 crisis countries with bad collateral. So, if the banks of Southern Europe go bust, so does the ECB. It has an equity capital of 500 billion or what, the total ECB system, and the right of losses, no one knows on these 900 billion. So the ECB cannot tolerate banks going bankrupt in Southern Europe, and therefore has urged the policymakers of Europe to set up the ESM, to allow the ESM to recapitalize the banks of the South. And also it wanted to have control of the process itself. Now it does itself the supervision and determines which banks would be eligible to the funds of the ESM. It's part of the problem. It's the perfect hostage of the capital market. It's sitting in the same boat as private investors in Southern Europe. And the next step will be Eurobonds. We are gradually approaching, we are close to Eurobonds already. Mario Monti's interpretation of the ESM is that it is already Eurobonds. There are no extra conditions beyond the fiscal compact. That's what he said. Germany does not yet agree, but it will agree. When Mr. Hollande asks Mrs. Merkel next year or so to have the Eurobonds, then she will not be able to say no. So that's the path dependency. It's this ongoing Ponzi game. But what will be the end? I don't know. Definitely the end is not a Europe which is still compatible with the rules of a market economy. Please allow me this little joke here. Because we have two big institutions, the ESM and the ECB, which channel the capital from the north to the south, or from one group of countries to another group, whoever that is in detail, at below market conditions. Politically, they fix the interest rate, the conditions, and then the money is being transported where where it wants that. And that is central planning of the capital market. It's no longer the investment managers whose care determines where in space an economy booms, which activities get money to grow and which ones shrink, which used to be the driving element of capitalism. But it's now these two state institutions with politicians that make that decision. That I find as the major problem in Europe. So, to summarize, it's a problem because these are fiscal rescue operations circumventing the parliaments. There's a substantial risk imposed on the core country taxpayers. Target is a risk. Mario Draghi's announcement that that he will buy the government bonds of countries that are about to go bankrupt before they go bankrupt, that's what he said, means that he will have the right of losses, and he means he will not be able to distribute the profits from money creation, the senior rich, to the finance ministers, and therefore the taxpayers of Europe will foot the bill. And even if no catastrophe happens, it's definitely an expropriation of the savers, because the ECB is underbidding the capital market and thereby driving down the interest rates. We already now have interest rates which are below the inflation rate. So savers are deprived of their interest income. If you save for 30 years or so, it's two-thirds, depending on what interest assumptions you make, of the funds which otherwise would have been available. German insurance companies are unable to provide the guaranteed minimum interest. German charitable institutions which are not allowed to use up the capital can't operate any longer because they don't earn interest. Everyone goes into shares nowadays because company stock at least generates some dividends, which is driving up the prices. We have this allocation through the Central Planning Agency. Money and capital flows to activities which don't deserve it. And the necessary correction of the capital market, which is taking place in principle, is being undermined through this policy. Let's look to the United States, how they did it. In America, we had a payment system which gradually evolved over time. In the 19th century, the settlement of target balances took place in this way. You know that very well from your Wild West movies. Gold was loaded onto a stagecoach, and the stagecoach was moving from one bank to another bank. Why that? Because Bank A had asked Bank B to carry out on its behalf a payment to a private client, maybe someone who was to deliver a good. So Bank B was giving Bank A a credit. But, there were other transactions in the other direction. They often netted out, but not always. And if they didn't, then that bank, which in net terms had asked others to carry out payments on its behalf, its own behalf, had to ship gold to the other bank. The settlement with gold has always been in history the mechanism to settle the balances, always. But of course it was dangerous and costly. So the Americans decided in 1914 to switch to another system. They created the Federal Reserve System with 12 district feds and put all the gold on a hip and said, rather than transporting the gold, we can have a balance sheet, and there we move the gold just on paper. Actually, gold-backed securities were used for settlement until 1975, after the Bretton Woods system had broken down, which was based on gold transfers for settlement between the participating countries. Also, internally, America moved to another system, and in that system, its shares in the market clearing portfolio, in the market portfolio, open market portfolio, which the Fed buys in terms of its money creation operations, which are being transferred. And that system up to this day exists. And here you see how the target balances, the gross target balances, developed in the United States. Always in April, there is a settlement. And you see before the settlement, there is an incentive already to reduce the local money supply to avoid the target balances, and meaning that private credit flows in from other districts. Here is an actual settlement in 2011. They postponed it for a year. 2012, there was again a settlement. And here you see the European curve relative to it, both expressed relative to GDP. Europe lacks a settlement mechanism. You can print your money, you can buy elsewhere what you want, and you just write it into the balance sheet and period. And there it stands forever. This, of course, creates strong incentives to misuse the system. If we don't solve this problem, I can't imagine that the euro survives. In the Bretton Woods system, settlement was also done with gold. You may have read in the newspaper that the Bundesbank is now bringing home the gold located with the Banque de France. Just yesterday, it was in the newspaper. In the Bretton Woods system, the balance of payment imbalances had to be settled with dollars or gold, since at the going parity, at the fixed parity. As the market price of gold at the time was lower than the parity price, the debtor countries preferred to pay in gold. So the Banque de France was paying the Bundesbank in gold, the Bank of England was paying the Bundesbank in gold, and so on. And the Bundesbank accumulated 3,600 tons of gold from target-like settlement processes at that time. This is the only gold it has up to this day. Now it's 20 times as valuable as before. The target claims, by contrast, evaporate with inflation. The necessary reforms of the Eurozone. First of all, we need a clear procedure how we want to handle a country which is in difficulties. If it is in difficulties, let's first assume it's a liquidity crisis, give generous help for a limited period of time, but then automatically, if the time elapsed, there has to be something more, and we need haircuts. The EEAG, the European Economic Advisory Group at CESIFO, has made a proposal with staggered haircuts according to maturity. If you're interested, look at our homepage. Second, we have to do something about countries for whom the way to prosperity and competitiveness is simply too large. You can squeeze Greece as much as you wish with more and more and more austerity programs. The prices are so sticky that you will not succeed in driving the prices down by 30–40% as is necessary. Okay, Germany can inflate away, but it doesn't. So in that situation, rather than sacrificing one generation of young people who don't find jobs, we have more than 50% unemployment, let them escape and allow them to exit the euro, to devalue, so that the people at home buy domestic products rather than imports. Greece is a net importer of agricultural products. Can you imagine that? They buy the tomatoes in Holland rather than growing their own. This is ridiculously wrong. And devaluation would increase the demand for domestic products, would create jobs at home, and would give ordinary people some hope. Some hope in the moment the situation in the euro is entirely hopeless. Where do you want to drive these countries? In Spain and in Greece, the unemployment rate is exploding at the margin. It's exploding. I can't imagine that this is possible. You drive these countries to a brink of a civil war with the current policies. So rather than saying the world goes under if a country like Greece exits, make it a controlled thing, organized, help Greece, help the Greek banks, which will have difficulties, help them with sensible imports, which become too expensive. You know, it costs a lot of money anyway. And in addition, give them the chance to return later into the currency union at a new exchange rate. Maybe legally they can stay a member of the currency union all the time. There are ways to do it. Rather this terrible nihilism of the policymakers that just have wishful thinking and don't see the reality makes me really nervous. We need a banking union, definitely, in the sense of a common regulation, common supervision of the banks. No doubt about that. The question is, do we need to mutualize the bank debt? Do we need public guarantees for the banks which are in trouble? I don't think so. 480 economists, not 200, have in two separate public pieces in the summer declared that they think the creditors of the banks of Southern Europe have to give up some of their claims. You can give them the shares if they're, but that won't be sufficient. So in the end, the creditors have to give way, and thereby we have to recapitalize the banks of Southern Europe. There's no other possibility. We can't ask the taxpayers to do that. The money is simply too much. Some people say, well, now we have rescued the states. Now, in addition, now we can also rescue the banks. This little extra money doesn't really matter. Macht den Kohl nicht fett. But I don't believe that this is right. Look at the total numbers here of bank debt. Italy, Spain, Greece, Portugal, Ireland, and Cyprus makes a total of 9.4 trillion euros banking debt. By comparison, the public debt of these countries is 3.5. The banking debt is nearly 3 times as large as the public debt. Guaranteeing the claims against states is one thing. This is hard enough for the community of states. Guaranteeing the claims against the banks of Southern Europe is a thing of impossibility. Actually, if you net out the bank holdings of government debt, the aggregate debt would be 11.5 or so, 11.6 trillion. Here you see the Banca d'Italia's estimate of the share of toxic loans to domestic households and firms. And here the Bank of Spain's own estimate of toxic loans to domestic households and firms. We're approaching here 12%. This is in the case of Spain. This in itself is in the case of Spain already half of the total equity stock of the banking sector. And there are more toxic assets in the balance sheets than just loans to domestic households and firms. The EU Commission is determined to go the other way. Here I read to you the Commission proposal for European Bank Resolution, paragraph 52. The bail-in tool maintaining the institution, the bank, as a going concern should maximize the value of the creditor's claims against the bank improve market certainty, and reassure counterparties. And now, in order to reassure investors and market counterparties and to minimize its impact, it is necessary to allow not to apply the bail-in tool until 1st of January 2018. So in other words, they want to have a guarantee for the banks of Southern Europe so that the investors who gave these banks money can be sure that they will get the money back. This goes too far. The same commission 10 years ago was right to say that the state guarantee for the German Landesbanken was not compatible with EU law and violating the rules of fair competition. So we sacrificed some of our Landesbanken for that purpose. WestLB just was shut down, and others will be coming. It's ironic that the same commission now wants to give that guarantee, which it abandoned in Germany, to the banks of Southern Europe. As I said, 480 professional German economists openly objected to this policy. If countries have difficulties financing their funds, why don't they issue covered bonds? We need a better collateral policy. If countries complain that the interest rates which the market charges are too high, well, convince the market that you will repay. They always claim they will repay for certainty. If you repay for certainty, for sure, then you can as well offer collateral, because it's no risk for you as a debtor. Finland in 1995 was in a big crisis, and in order to be able to borrow, they issued covered bonds, collateralized with real estate property of the Finnish state. New York, when it went close to bankrupt in the early 1970s, in 1975, offered covered bonds to convince the market, collateralized with prior claims on future New York tax revenue. So why is it not possible? The Greek state owns real estate property worth 1 GDP. Now they found gas in the Aegeis, which seem to be very big fields. So there's every possibility to collateralize. In the end, despite all my criticism, I remain a European believer. And I still think the euro should be maintained. It's broken, so we have to fix it for sure, but we should not abandon the euro. But we should reduce it to a number of countries that can reasonably operate under the euro. And in the end, we have to continue the path towards European integration, but we have to go the full way. We cannot just hand over the money without having the political union. Sometimes I see the relationship between France and Germany like an intended marriage. No? Germany is the bride, which is a little bit ugly, and the man in France doesn't really love her, but she has money. And now the bride says, yes, I'm willing to give my money if we can marry. First we sign the marriage contract, but the guy says, well, can't you hand over the money first, and then we will see. That's a little bit the problem. To be serious again, I think we need to create the United States of Europe. Switzerland gives a good model of how that could work internally. We need a common army, we need a common government, we need a parliament with democratic representation. But what we don't need is a mutualization of the old debt. That under no circumstances. Why not? Because debt mutualization destroys the liability principle, which is the driving principle of prudence for any economic system. Look at what happened in America. This is Alexander Hamilton. Alexander Hamilton, the first finance minister, in 1792, mutualized the state debt. After all, they had fought the war against the Brits, and depending on where the fights were, there were more debt here and less there, so they socialized this debt. Made sense. Then they mutualized the debt another time in the Second War against Britain, 1813. And so the states developed the expectation, oh, well, whatever we take as debt, that will be socialized and become public debt of the whole federation. They built canals, infrastructure, sometimes good projects, sometimes not so good. There was a big credit bubble, which burst in 1838. From 1838 to 1842, there was the big crisis in America. More than half of the American states went bankrupt in these 4 years. And there was nothing but strife resulting from it. Nothing but strife. I cite Harold James, the famous historian from Princeton University. He said, "The Hamiltonian scheme of federal finance did not guarantee a peaceful commonwealth. In fact, the fiscal union proved to be explosive rather than, as Hamilton had argued, cement." Thank you very much for your attention.
Thank you. Thank you very much, Professor Sinn. And of course, if you have any questions for Professor Sinn, please memorize them, or even better, write them down. You will have plenty of opportunity to confront him with your questions, to discuss them with him or with any of the other experts right after this quick break in our panel discussion. First, we want to digest what we have heard so far. Coffee and snacks are to be found outside. And we'll meet again in about 15 to 20 minutes' time. Until then.